like to buy best in class on sale for whatever reason. And so, like, CrowdStrike was a perfect example. I have never owned it because it was always expensive, and then they had the Microsoft issue, and it fell 40%. You can get best in class number one company on sale down 40% with a phenomenal management team. It's going to be expensive, but relative to its historical average, I thought it was very cheap. So there's a price for everything, and I like to look at the comparisons. I like to look at the 5-year averages, the 10-year averages in the past. I like to look at EV to EBITDA. I like to look at price to sales. There's a lot of different ways to look, as you both know. Every industry is different in terms of what valuation metric actually matters. But when I see that a best-in-class company is down, or it's lagged, if I understand the reason why, and I think that there's a catalyst to change that, then I will buy something that's trading at 30 times forward estimates if I believe that they can recover and the earnings will be revised higher.
A very warm welcome to the Risk Reversal Podcast. The laughter you hear in the background is the laughter of Stephanie Link, last with us, Dan, on Valentine's Day of this year.
That would be February 14th.
I appreciate that.
Right,
Thank you. Yes, I know these things.
Right.
I say it all the time. Stephanie will appear on every show on CNBC except Fast Money. Obviously, she has some sort of reluctance to come on with us, which I totally understand. But you legit can see her on every single show. Obviously, a lot of people know her from the halftime report, but she will be on Closing Bell. She'll be on the morning shows, and rightly so, because as I've also said, Stephanie is one of the voices you want to turn the volume up for when she's on. So we're fortunate to have you back, Stephanie. How are you? By the way, Stephanie Link is the Chief Investment Strategist and Portfolio Manager at Hightower Advisors. With that said, hello, Steph.
Hi, guys. How are you?
We're doing well. So let's get right into it because you have been very optimistic. You've been very right. We're going to get into some granular names, but here we are sitting here on a Thursday afternoon. The S&P is effectively at an all-time high. It has shrugged off what we saw in early April in a historic fashion. Is it continued sort of green lights ahead, or anything's out there that are concerning to you?
Well, and thanks for having me back on. It's great to be here. I would say I always worry about things. I mean, I worry when I don't worry because that means we're being too complacent. So there's plenty of things out there. But I will say, in the face of all the things that we went through over the last couple of months, the fact that in the face of tariffs and the unknowns on geopolitics and inflation and the Fed, we're still growing GDP at 2.5%. I mean, that's pretty remarkable. The consumer continues to spend. Sure, the low end is definitely softening, no question, but the consumer has a job. And if they have a job and they're making money, they're going to spend. And inflation has been coming down. And gasoline prices are down 12.5%. Nobody talks about that. Everyone wanted to obsess about egg prices, but gasoline is way more important. And so I think you add all these things up, and it's actually pretty encouraging. And why do we care about macro? Because it impacts earnings, and stocks follow earnings on the way up and on the way down. And I do think we're set to see pretty good earnings reports starting next week. The consensus is about 5% growth. I think you're going to do 10 easily because the economy continues to kind of hum along.
Let me ask you this, since you brought up the consumer, and I agree with you. I've learned the hard way over the years that to discount the U.S. consumer is typically a fool's errand. And what I've said and what I'll say here is never underestimate the U.S. consumers want to spend. They'll do it in just about every circumstances. My question back to you, are they in a position to spend? And I say that through the lens of delinquency rates. I know you watch all these things. You know, all the different metrics are seemingly showing delinquency rates climbing anywhere to 8 to 12-year highs or levels that we saw 8 or 12 years ago. And I think, for me at least, there's some trepidation that, yeah, they're spending, but maybe they shouldn't be.
Well, yeah, we are a nation of spenders, whether we have the money or not. And I agree with you. It's always been a fool's errand to bet against the consumer. And that's the reason, because they do spend. They spend in different ways. They spend in different places. They're not spending on goods. And that's why some of the department stores and the packaged food companies are hurting, but they're spending on services. Just look at what Delta said today. They didn't say everything was perfect, right? They said the front of the cabin was great. Well, the front of the cabin is what they care about the most. And the front of the cabin is actually packed and you can't get a seat there, whether you're business or not. Restaurants and hotels, and even like going back to to Delta, but the I don't know if you guys have been traveling lately, but the airports are simply mobbed. So consumer is kind of spending where they want to. I think that's going to continue. And I go back to jobs. If they have jobs, they then also are making money, and that's why they're going to spend. And I know I agree with you on the delinquency rates rising, but they're still at historically low levels. So yeah, you got to watch that, but still very very healthy trends, especially from the big banks. And I think overall, when we look at jobs overall, I look at the weekly jobless claims, not the non-farm payroll numbers. The weekly jobless claims are running at about 235,000 a week. Recession is 350 to 375,000 weekly jobless claims. So we're at 230, 235. Yeah, it's inching higher, but it's still very contained. And that's what I pay attention to the most. It's all about the labor market for me.
Yeah, it's interesting. You just used the word recession. It's not something that has been too much in the investor lexicon. I don't think in 2025. I mean, you think about it, even in the face of uncertainty about a trade war and the like, I don't think there's many strategists out there who have been suggesting, or economists, that we're about to be in a recession. And clearly the stock market is not sniffing that out right now. You could say, well, back in early April, that was the sort of case. I don't even think folks were even suggesting that back then. I think plenty of people got burned 2022, 2023, 2024, thinking about that. But let's go back to your point about S&P 500 earnings, expectations for Q2 right now. Consensus is 5% year over year growth. You just said you think it could be double that. Our main man, John Butters, over there at FactSet, he had a report out in the Earnings Insight blog just the other day suggesting exactly that. If you think about sort of growth rates, they come down over the course of the quarter, but it's like, I don't know, what was the number? Like 75% of the time over the last 10 years they beat, and they beat by X%.
37 out of 40 quarters, yeah. I think it was.
And the consensus is way too low. Okay, so if that's already built in stuff, like, you know what I mean? Like, that's the whisper number. Let's call that. Like, will it be enough with the S&P at 6,200 with a consensus that looks like 265 in earnings or 270? It's an expensive S&P. You're almost going to have to see a re-acceleration in growth in the back half of the year to justify the valuation. Does that make some sense?
Yeah, I mean, look, I think that the earnings are going to be better than expected. I think it's going to be top line mid-single digits. I think it's margins that are going to surprise to the upside. A lot of people are calling for margins to roll and roll hard. I don't see it at all. Our U.S. companies are very dynamic. They restructure, they reorganize, they're going to increase price, offsetting some of the tariffs. And I think it'll be fine. I think the key is going to be guidance, because last quarter we had about a quarter of the S&P 500 companies that didn't give guidance. I think you're going to get guidance, and I think people are going to feel better because we are getting through tariffs. Yeah, we don't really know what the number is going to be, but it's like we're long in the tooth there. And then after we get past that, which I, by the way, do not think is inflationary because we have productivity that's going to offset it. But once we get past tariffs, you've got deregulation, and you have also lower tax rates, and you're going to see CapEx, I think, continue to work higher. And that's very positive for equity. So yeah, markets are expensive at 22 times, totally agree. But there are pockets in this market in the markets that are not expensive. I look at the financials. I look at some of the industrials. I look at a lot of the discretionary, in particular housing. Like, there's a lot there that are in the low teens in terms of multiples. And so I don't necessarily want to own the broad-based S&P 500. I just want to be picking the right sectors and where I have a lot of conviction.
All right. Are you getting a bit choosy, though, within sectors like the financials? Because, again, JP Morgan is not trading particularly cheap, and it's really been a leader in the space, and it's broken out. It's been on a runaway breakout, that sort of thing. It seems to be discounting really nothing as we head into its print next week. So are there some landmines? Well, I mean, let's call it what it is, right? And so it just becomes harder to see how these stocks, and you could say, well, you've been fighting them the whole way, Dan. You know what I mean? But as they've gone this way into an event, I'm just hard pressed to see what they can say, what they can print that's going to make the stock go materially higher.
I think they're going to say the consumer is hanging in there. I think they're going to say that we are having a manufacturing renaissance tied to this AI data center grid theme that we all have been talking about for a couple of years now. I think that charge-offs are going to be tame, and I also think they're going to say net interest income has bottomed, and we're going to start to see a recovery. A couple of banks said that last quarter. You know what? It's been about 10 years since we've seen net interest income recover. That would be something that I don't think a lot of people are talking about. And in addition, how the M&A cycle is, we're about to see one. It's improving. The pipelines are very strong, very healthy. All of them said it last quarter, but we just didn't see activity because of it. But I think you're going to start to see M&A and capital markets improve. And I go back to deregulation. These banks have had significant regulation on top of them since 2008. And now all of a sudden you're going to get the SLRs that are going to come down. You're going to have IPOs, the costs coming down because companies know, the SEC and the exchanges know, it's too difficult to be a public company. It's too expensive. So they're going to relax the cost and the rules there. We just got the stress tests. A lot of pretty much everybody passed. It wasn't really a surprise, but we got a lot of dividend boosts, on average about 7%. We had a couple buyback announcements as well. So I think that trading at about 12 times earnings and trading at about 1.2, 1.5 times book, that's for everybody other than JP. I think it's still attractive. The space is still attractive. And I also think the sell-off in the private markets companies has been pretty extreme, and I think you can be buying some of them as well.
You mentioned home builders, so let's go there. All the charts look pretty much the same, whatever four you want to choose from. They all sort of topped out in the fall of last year. They all sort of bottomed out, I don't know, mid-April-ish. They've all been bouncing a little bit, but not in a material way. In order to be bullish of the home builders, is your view, and I know the answer to this is some combination, but what is more important, that rates come down in a meaningful way or the job market continues to hang in there? Because my assertion is if the job market starts to deteriorate, rates don't really mean all that much. That could be the bugaboo for the housing market.
Well, sure. I mean, I think jobs is important for so many parts of our economy, as we just talked about. But I just don't see it deteriorating rapidly. Now, look, if weekly jobless claims goes to 260 from here, I'll start to worry for sure. But we're kind of hanging out at this 230, 240 range now. And so I don't worry as much there. I do think rates have to come down. We just saw the best mortgage application rate number yesterday in 3 months because we're at 3 month lows in the 30-year fixed. So rates, you can see there's pent up demand. We're 5 million homes short in the country. If you talk to any home builder, they have underproduced for 15 consecutive years. They'd rather buy back their stock than build. And I think the numbers have been pretty de-risked. And you're talking about like 8, 9, 10 times earnings. And I think you're kind of at a trough. So they've rallied off the lows, you're right. Could they sell off if they report, kind of inline numbers? Sure. But I do think in a year's time, rates do come down. And I think that this is one of the most attractive risk rewards in my mind, just given the supply demand dynamics.
Steph, and this is related to housing. It just seems to me with the S&P, at, all-time highs, you have a VIX at 16. You say to yourself, okay, we don't really seem to care about tariffs. The president's been throwing around like 50% on Brazil, 50% on copper. I mean, the list goes on and on. If you have a 50% tariff on copper and we get, let's say, a third to a half of our copper from overseas, right? Like outside the U.S., we produce a lot of copper here. Well, copper goes in to a whole host of things as it relates to construction, as it relates to, like industrial. I mean, it goes on and on, like you want to reshore things, you want to build factories, you need copper. You know what I mean? Like, so there's a lot of stuff that's going around and around. And so my point is, like, this could go on longer than people think it could. And the markets right now are just really, there's no pricing in anything. And that's the one thing that I think frustrates me. And that, you and I had not talked in a few months about the markets. I was not pressing those. I was not bearish on the market when it seemed like we had a massive disconnect relative to what we think we knew, about a trade war before the tax cuts. And I want to say one other thing. There are no tax cuts. It's an extension of the tax cuts from 2017. Corporate tax rates are not going down. So if people keep saying that that's some sort of tailwind, Well, it's not, right? So now the trade stuff, it just seems to be there's no discounting anything here. And that could be the bugaboo, in my opinion, for at least economic growth, the way you're thinking about it, because you're talking about margins improving. You're talking about S&P 500 earnings improving on the back of that. But, 50% tariffs here or 25% tariffs on autos. I mean, the list goes on and on. Make no mistake. These are taxes on the importers and they're taxes on our consumers.
There's no question, but I don't think we're going to see 50% tax on copper. I just don't see it. I don't look, at the end of the day, he's a real estate guy. He knows copper better than anybody, right? So he wants lower rates. He wants to threaten a lot of different things. And I think they're going to come to a negotiation. He wants better growth. I do think, though, that the tax rules that the bill that passed, I do think it's a sigh of relief for corporations because now they know what the game is, right? Now they know that they can continue to do what they have been doing in terms of increasing capex. And they also know that there are areas where they must spend an increase in capex, like AI, like cybersecurity. So, yeah, I understand what you're saying in terms of higher tariffs. They're coming. But what if we have better growth in the back half of the year because of these things that I just mentioned in terms of tax and in terms of deregulation? Maybe we have a little bit better growth and maybe we have a little bit better productivity, and that'll help offset some of the higher inflation fears out there. But there's no question. I mean, we're all wondering about it. You guys started the conversation by saying, do you worry about something? I do worry about that a lot, right? But I'm going to go with the premise of he's not going to have these extremes. He's just going out there that he's a negotiator.
I agree. That's the taco trade. I think we learned it, the hard way in early April, and I think it's become easier to kind of get your arms around it. But explain to me, like I'm an idiot, and that shouldn't be hard for you to do. What does deregulation actually do for economic growth?
Oh my goodness, deregulation? You're kidding me? I mean, especially for the financial services sector, that is actually the biggest industry for promoting lending and for growth. And if they have more capital, then they don't have to tie it up like they've had to over the last several years since 2008. If they have more capital, just ask Jamie Dimon. He's like, I want to lend more, and I want to increase my market share. All of the companies are doing that. They're going to lend more. They're going to buy back stock more. They're going to increase dividends more. I think it'll be a healthier system overall. And I just think that liquidity is really very, very important. It gives them a lot of flexibility to grow and to lend. And so for the first time in forever, we will actually see mid-single digit loan growth because we know it's been abysmal since 2008.
Yeah, but the irony is 2008, it was kind of a lending issue. Things got a little bit too lax. That's why we had the regulation. And you know where Jamie Dimon wants to lend to private credit, right? So think about that, right? So now we have this whole pocket of risk that's far less regulated. It's been deregulated. It's not in the banking system for the most part. So, I just think about this. We can go around and around about this. I just don't think that the banks having more capital to lend is going to be the sort of economic tailwind that a lot of folks, think. I just coming into this year, coming into the new administration, the pro-growth agenda, we're going to get tax cuts. No, we're going to get extension of tax cuts. They already talked tough as far as trade. They were talking tough about, immigration or deportation. Well, that is inflationary, right? I just think there's a whole things that are not exactly lining up, but it's been easy for market participants to say, you know what, the worst is behind us as far as the economy is concerned, as far as the policy errors, and at least in the rollout of some of this stuff. And when it happens like this, when it sounds so good, and the VIX is going to 14 right now, and the S&P is going to everyone's targets at 6,600, 6,700, nothing can go wrong.
Well, look, I'm not trying to whistle past the graveyard, right? I mean, we are headed into a seasonally sluggish period for the markets overall, and we are up 25% from the April lows. We've had a nice rally. Could we give some of it back? Of course we could. Of course we could. But in terms of growth overall, it's not just deregulation. That's just one piece of it. What if tariffs actually work? What if actually the reshoring, onshoring actually leads to better growth here in the USA? We are seeing it already. We're seeing companies build here and have plans to build here for many, many, many more years. And that I think is going to be very positive as well. We have a manufacturing renaissance going on tied to AI, data center, grid, and power. And by the way, did you guys know that 75% of the grid is over 25 years old? So imagine the spending that has to occur to have all of this, if you believe in AI, to have it all come. And maybe what if it's even just half of as exciting as we expect it to be? It's still really a huge bunch of growth. And you have these hyperscalers that are spending $350 billion. I mean, this money is going to lead to, I think, better activity. Does it lead to 5% growth? No, of course not. But I would be happy with 2.5%, 3%.
And that is definitely some of the enthusiasm and optimism around exactly what you just said. I mean, the whole infrastructure thing, the manufacturing renaissance, without question. But I'm going to shift gears a little bit, but not entirely. Clearly, the weaker U.S. dollar against a myriad of different currencies, specifically against the euro, has been a tailwind for the market. Is there a point, in your opinion, where that tailwind becomes a problem? In other words, I know you know what I'm asking, but can the dollar get too low and then all of a sudden it becomes problematic?
There's no question about that, but I do think that it's all about the speed, so the velocity of the move. If we race down another 10%, that would be very concerning. But if it kind of just sits here, can kind of be weak. I mean, was it overvalued to begin with? I don't really know. I'm not a currency expert. What I can tell you is I don't mind a weaker dollar because it does help U.S. multinational companies and the earnings. Although I know all three of us don't pay a multiple point for currency moves, right, on earnings. I get that. But I think it's all about the speed, Guy, and watching that. By the way, one last thing, Dan, on your last question. You know, there's $7 trillion of cash on the sidelines right now. So there are a lot of people that missed the bottom, the April bottom. And I think it's really the sentiment is so negative as a result of this rally that we've seen. So that's just one other thing.
Yeah, and I heard Jim Kramer the other morning on one of the shows talk about how he thinks we're like 1996 of the, if you were going to equate it to going back 30 years ago where we had 4 or 5 consecutive years of 25% returns. We just had 2 consecutive ones. You think about right now, we're doing pretty well, So if you're talking about this cash, if you're talking about deregulation, if you're talking about this reshoring renaissance, if you're talking about hundreds of billions of dollars in CapEx that's being spent, I'm not so sure that's being spent around in a way that is going to be so advantageous, right, for economic growth here. I know it does things in certain slivers of the economy. That's the one thing it's kind of hard for me to kind of get my head around. And I know that we were just talking about a weak dollar, but I also have trouble thinking about what happens if we start lowering interest rates or the Fed starts lowering interest rates and we have not sort of slayed the inflation dragon, if you will. And then let's just say, we have employment that you think is going to be doing better than a lot of folks think. Well, that could also be inflationary, right? So I just think there's a whole host of things. I don't mean to sound so negative. I'm just saying that I've just found myself over the last month in this period that we've gone from like 5850 up 1,000 points in the S&P from the lows in April to 62.50, and there doesn't seem to be a care in the world.
I think that there are a lot of issues out there, and as I mentioned, I think a lot of people are still pretty cautious, and I think it doesn't help that every day on the network we're on and other networks that we're on, I mean, they just always are focusing on kind of the negatives and tariffs and the bad headlines. And so, I mean, I just think at the end of the day, like there is parts of the economy that it's not just manufacturing that's leading to better growth. It goes right back to that consumer. So watch the consumer, watch the labor market. And I don't have a crystal ball, but I'm reading and I'm hearing, I'm listening to companies and what they have to say. And they're feeling better, at least when versus April or March, that kind of thing. And sentiment goes a long way, So I think that I don't know. I mean, I have a lot of concerns, but I'm trying to find the positives and the glass half fulls. And we'll hear starting next week with earnings. I think we're going to hear okay things.
Let's play a little stock market. The last time we were together, we both had a very similar view on Boeing. I think the stock was probably trading around 175 at the time. It subsequently traded down, I think, 129 in April, like everything else. But here we are sitting at levels that I think we both thought we should be at in the first place, somewhere between 225 and 230. Personally, I still think there's some room to the upside. I think you share that view. What are your thoughts on Boeing here in the back half of the year?
Yeah, well, in January, I said on TV that it was my favorite idea in the entire market, and that is because of Kelly Ortberg, right? And just knowing his track record at Collins when he was there, the stock at the time went up 119% in the couple of years that he was there. So he was able to execute and grow and focus on margins and profitability and all that. And I thought he would bring it to Boeing, and he has. I mean, last quarter, Guy, you know this just as well as I do. It's the first time we saw operating margin expansion year over year in like 5, 6, 7 years. It's crazy. And he's only there for a short period of time. So I think him just hiring a new CFO, they worked together at UTX. So I think that will be a nice synergy as well. And they just had the best deliveries quarter in the second quarter since 2018. And so I think it still has room to go. And I still think, the analysts out there, there's only, it's like half have buys and half have holds and sells. So there are still upgrades to be had. And I think most importantly, as they deliver more and more planes, their free cash flow goes from negative $2 billion to we could see $12 billion by 2027. And that's, what the stock really trades on. It's all about free cash flow.
I'm totally with you. And Rockwell Collins is one of the great companies that, we used to talk about on our show that nobody really had ever heard of. They subsequently got acquired. I think he started his career at like Texas Instruments too, as like an engineer. I mean, it's a brilliant man. It feels like there's something going on at Boeing that people are sort of not, I think, appreciating enough. But I'll shift gears a little bit again because, we started talking about the consumer. It's a Walmart world, and a lot of people will say, you know what, I get the Walmart story, but just in terms of risk, reward, and valuation, Target's got to play catch up at some point. And that Target has bounced a little bit since the April low, but not nearly to the extent that the broader market. Personally, I think there's some still huge problems at Target. I think you share a different view. So what are you doing with Target here?
I think there should be an activist that gets involved in the company because I think it's not about people know what Target is. It used to be a great brand and it has a lot of growth in terms of store unit growth, which a lot of retailers don't have. And I think they have good products. The problem was that they had too much discretionary goods versus consumables during COVID. They messed up inventories. It took them a long time to get that corrected. And for the first time last quarter, they saw negative traffic growth. The thing that I held my hat on was really that they had traffic growth. They just couldn't see conversion. But last quarter, they had negative traffic growth. So I got to tell you, I mean, I couldn't be more negative about it, but I can't possibly sell it at this valuation. And if Dan Cornell goes, I think the stock rallies 10%.
I agree with that, by the way. I agree with that. I don't think he's going anytime soon, is my instinct. I mean, he seems embedded there, but he has not been a particularly good operator over the last now, I think, to your point, since 2021-ish. I think that's when the stock made its all-time high, and here we are today. So I'm with you on the Target front. Personally, I still think it's Walmart's world. We'll see. But in terms of, again, in the consumer, you mentioned how, again, the front of the plane, business class, first class, absolutely right. And that chasm between the upper end and the lower end continues to grind wider and wider. But there's the other side of that coin, are the dollar stores, which recently have gotten off the mat. My question to you is that just a blip, or is there something here in terms of like the Dollar Gens of the world?
I think it's a blip. I really do. I think you're right. Walmart is stealing share left, right, and center. I think you have the haves and the have-nots in retail, right? You have Amazon, they're the behemoth. You have Costco, and you have Walmart. And I'm hoping that Target can get its act together and get back into that group, but it remains to be seen. I just think it's too tough. The low end is tough, really tough. And oh, by the way, the thing that gets me really confused about the dollar stores, they've changed their strategy not to offer a dollar for goods. So what are they? Are they the $3 store or are they the $1 store? I don't really know, but it's confusing to me, but I do think they are losing share.
Come on, Steph, that's semantics, right? I mean, I like what you did there, but all right, let's talk about consumer discretionary then. So if the low end, we know that there's some pressure there. Some of the bounces that we've seen, you talked about Brian Cornell getting booted out. We saw what happened with Starbucks, last year. A lot of management changes can kind of yield those sorts of things. But what are some of the things as far as discretionary? We just saw Disney rally the way it did. We saw Nike rally the way it did. But then on the flip side of that, Lulu can't get out of its own way. So those are maybe company specific sort of issues. But how are you thinking about consumer discretionary, especially if, to your point, if the banks start lending again, if the housing market loosens up again, if the stock market keeps going higher, I think that consumer discretionary should play catch up.
100%. My favorite three sectors: industrials, financials, and consumer discretionary. And that's really discretionary because it's lagged so much. And I actually not really focused on only services or only certain parts. And we mentioned housing, that's a big part of it. I think some of the services companies will still do well. I like Chipotle. That's lagged. And I like the CEO, the new CEO, when Brian Niccol left and the COO became CEO. That stock has lagged in a big way. They've got product, they've got traffic, they've got productivity. I know it's expensive, but it is down. It is trading at like a 15% discount to its historical multiple. And so I think that can actually work in the back half of the year. I like Las Vegas Sands. Now that's not a it's a US company, but they're 100% overseas, 60% Macau, 40% Singapore. I think we're just getting started on Macau recovering, and we're starting to get the gross gaming revenues to actually beat expectations. That's an awfully cheap stock too. And so I think there are pockets of places of consumer that I still feel really good about. And so making some pretty big bets on some stocks that haven't really worked yet. So I'm hoping I'm right.
I think there was a big win upgrade earlier this week as well. So I think there's some people that feel the same way you do about some of these casino names. Energy, broad top, very broad sector, I know, but a sector that I think is underloved. You can make a case on valuation across a swath of the energy space. Is there any place you're looking at there that interests you?
Guy, I've been trimming, believe it or not. When we have a president that wants lower oil prices and actually was able to convince the Saudis and OPEC, to increase production in lieu of us getting a lot of their AI business, like that just tells you everything you need to know. I just think it's too hard. Now, what will happen is you're going to see activity really plummet, and that should see you should see a bottom in energy prices as a result. But I think you're a couple of years away from that, to be honest with you. So I think it's a hard sector, and it's only 3% of the S&P 500. So like as a generalist, I don't need to even think about energy. I know they're cheap. I know it, but too hard.
All right, I want to get to tech, but we talk valuation here. Let's talk about it on a single stock basis before we get to tech. When you say it's expensive, that's okay. You know what I mean? This was the Chipotle, or energy, it's too cheap, but that sort of thing. How important is your valuation frameworks? Is it industry by industry? Is it do you work top down then bottom up? How do you think about valuation?
Yeah, I mean, look, I'm very valuation centric. I like to buy best in class on sale for whatever reason, and so like CrowdStrike was a perfect example. I have never owned it because it was always expensive, and then they had the Microsoft issue, and it fell 40%. You can get best in class number one company on sale down 40% with a phenomenal management team. It's going to be expensive, but relative to its historical average, I thought it was very cheap. So there's a price for everything, and I like to look at the comparisons. I like to look at the 5-year averages, the 10-year averages in the past. I like to look at EV to EBITDA. I like to look at price to sales. There's a lot of different ways to look, as you both know. Every industry is different in terms of what valuation metric actually matters. But when I see that a best-in-class company is down, or it's lagged, if I understand the reason why, and I think that there's a catalyst to change that, then I will buy something that's trading at 30 times forward estimates if I believe that they can recover and the earnings will be revised higher. So it all depends. It is industry by industry. And just my process is I do think big picture, and then I think about themes, and then I look at the stocks that will benefit those themes.
Let's talk about a big theme, and let's talk about a name that's kind of being left behind by some of its peers. It trades cheap to itself. It trades cheap to the market. It trades cheap to its peers. It's Google. Okay, so here's one. Is this a company, great management, great moats, that is on sale?
I think it is. I think there's a lot of overhang on regulatory issues, and I think there's a lot of concern out there, myself included, on all of the AI that's out there. Like I don't even use the search anymore. I don't go to Google. I'm going to ChatGPT, right? And I know my 18-year-old and all of her friends are doing that. They don't use the search bar. Now, that being said, that's only one piece of the story. And if they do have to split up the company, I actually think splitting it up, it would be a great decision. I love splits. You know that about me, right? But I think that if they were to split it out, that would be more interesting to me. But I think the regulatory overhang is just it's so great. And then again, AI as the competition.
Do you think that regulatory overhang, though, broadens out a little bit? I mean, Guy and I have talked about this a lot now for the last few months, going back to the dais at the inauguration when we had all of those major CEOs and tech, line up behind the president. And, there's been a lot of regulatory action that has not been, swept by the wayside. Google is Exhibit A. Apple is trying to get rid of something. You have Meta. You have, the list goes on. And I think that might stick around a little bit. Vice President Vance, he seemed to be a fan of Lena Khan. So we're not seeing a lot of shift on that front, so that's interesting to me because it's also all these companies that have committed to spend hundreds of billions of dollars here in the US. And it seems like 2 years ago, they weren't doing this. A year ago, they weren't doing it, or at least committing to do it here. So it seems like a little bit of pandering to the administration, which I'm in the belief that at some point in the back half of this administration, I think these companies are going to pull back on some of those sorts of desires to build manufacturing here, because I don't know about you and your 18-year-old, but they aren't spending $2,000 on an iPhone in 2 years from now because they're being manufactured here.
Yeah, I'm not a fan of Apple, and I haven't been for a while. They've really missed the boat on AI. I can't believe they just lost their number one AI guy. I think they're in a world of hurt because even if they do partner up with AI, I think it'll take two more phones for it to be a super cycle. And you really do need a super cycle. You can say you love services all you like, but it's 25% of the revenues. So that's not even an issue. Regulatory, yeah, there's no question. I think they're in the crosshairs, but Google really is in the crosshairs. I think one other reason, by the way, that I didn't mention about Google underperforming is because they haven't monetized AI yet. When you look at Meta, they actually are. If you look at their AI ads, it's actually increased 7% of time spent on Facebook and 6% time spent on Instagram. That's real money. And they price per ad is up 10% as a result. That's real monetization. Google hasn't seen it yet. Not even Amazon has seen it, and Apple is nowhere to be found. So I think, yeah, regulation is something to watch, but I think it's a couple of things on Google that are reasons why it has underperformed. By the way, one other thing. Do you notice that every day we wake up and Mark Zuckerberg at Meta, he's buying these people in AI, he's buying a small ownership position in a variety of different AI companies. He's not going after buying an entire company because he knows he can't, because regulators wouldn't allow it. But he's buying slowly but surely little pieces of companies in the AI world to help build out that book. I like what he's doing much better than what I see out of Google.
Facebook is obviously monetized AI without question. We've talked about it. Walmart's the other company. In terms of the big ones, it's done a good job. So here, my final question to you. We've talked for over 30 minutes. What haven't we brought up that you're saying, you know what, I wish Dan would ask, I wish Guy would ask? Is there anything out there that you're watching that we haven't talked about?
Well, no, I mean you're pushing back on all my positives, so I'm good on I'm good on trying to defend myself over here. I'm going to wave the little white flag, but no, I mean you touched on everything, and we should be doing that when the market is up this much from the lows. We absolutely should be looking under the covers to seeing what is out there that could scare us and that could lead to a pullback. But I think, Guy, I mean it's like the long-term average of the S&P 500. It's 7.7%. And if you do get a pullback with the strong fundamentals at US corporations, with the transparency, with the free cash flow, and the ability to hang in with margins, not even expand them. In a downturn, these companies will cut costs faster than anything. They will adapt and adjust. And you find some really good companies that fall 10, 15, 20%, like we saw back in April. You want to buy best in breed on sale. You want to buy number one company on sale. You don't need to buy number 3 or number 4. They're number 3 or number 4 for a reason. So if I could get Walmart down 10%, man, I would be all over that. If I could get IBM, which is kind of come back from the dead, down 10%, I would buy that one. he's a master. And there's so many other companies out there that I kind of keep my list out for. But no, you nailed all the stuff that I had to try to defend. So,
well, you
we'll
do
see
it
who's
elegantly, intelligently, as you always do. By the way, I think you'll be happy to know that on my 900-song Spotify playlist, White Flag made it. You never wave the white flag because you have no reason to. But Stephanie, once again, thanks for joining us.
Thanks, guys. It's a pleasure.
Thanks, Steph.